part 3 of the Swiss Association of Market Technician interview with Dr. Van Tharp. We'll be discussing simple rules to make money. Pleasure to have you back on the show, Dr. Tharp.
It's a pleasure to be back, Ron.
And in this third follow-up series, we'll be talking about simple rules to make money. And everyone seems to ask the question, how do we make money, or how do we avoid losing money? What Tharp think concepts can you share with us?
So if we go back to the last talk, we were talking about the map is not the territory. And the map might be a global thing, like how you think about the market, but it might, or a task of trading or something like that, or it might be as simple as a belief. The belief might be part of a map, or it might be a map in and of itself. So in my book, Trading Beyond the Matrix, there's a bunch of Tharp think beliefs that are very useful for making money. And by the way, for those who are attending my talk on October 11th in London, we'll be giving away that book and I'll be autographing them. So perhaps that's an incentive to attend. But there are 55 beliefs in there, and I can give you like 4 that should make anybody a lot of money. So let's look at those 4. The first belief is that when you enter into a trade, you need to have some idea about when you're wrong, which is your initial risk, and I call it R for short. So when you enter in the trade, you need to have some idea when you're going to get out, because your whatever concept you have isn't working, and you're wrong about the trade, and that's your risk, or 1R. Second concept is when you enter in the trade, you need to understand what your potential reward to risk ratio is, and it should be at least 3 to 1. So that means you don't have to be right all the time, because you're going to make more money, at least 3 times as much money when you're right as when you're wrong. And so let's say you have 10 trades, and 4 times you make 3 times your risk, and 6 times you lose 1R. So you're only right 40% of the time, but you'll make 12R in the 4 winners and 6R in the 6 losses. And the net result of that is making money you don't have to be right, because you have a net gain of 6R, or 0.6R per trade, despite being wrong 60% of the time.
And isn't this the common error, that we always want to be right and think that that's the way to make money?
Right, and what I just described, you're wrong a majority of the time, but you're still making 6R. So let's say you make 10 trades a month like that. And position size is important. So you made sure that your risk was 1% every time you took a risk. So if you made every trade, 10 trades, you make 6R, you're up 6% at the end of the month. And if you kept that up every month, you'd be up 72% at the end of the year, which would make you one of the best traders in the world. So that should be really easy. It sounds like a formula for being a genius. But why isn't it? Well, first of all, if it were easy to make money in the markets, big money wouldn't let you play the game. So you know how you have to pass exams to be a broker or a commodity trader or something like that. You have to pass in the States, it's a Series 5 or a Series 7. And you'd have to have, so big money would require you to take all sorts of tests, and then you have to work for them. But because it isn't easy, lots of psychology is involved. You're encouraged to play the game. If you got some money, go open an account and let's see how fast you can lose your money to us.
And this is part of the challenge, in that people realize it's actually much harder than it looks on face value, and that there is work to be done.
Right. So one of the tasks that we like people to do is to keep track of their mistakes. So my definition of a mistake is when you don't follow your rules. And if you don't have any rules, everything you do is a mistake. And then when you do follow your, so maybe the set of rules, there's an entry signal. I didn't talk about that, but is it going up? If it's going up in a nice straight line, you might enter, and so on and so forth. You take a 25% trailing stop, something like that. But you have all these simple rules. And then when you don't follow your rules, that's a mistake. So, and what we find is we have people keep track of their errors when they're not following the rules or their mistakes, and keep track of them in terms of what it costs them in terms of R, the R multiples. So let's say, I think most people would find they'd be lucky to be 70% efficient, and that means they'd make 3 errors and 10 trades. And let's say each mistake cost you 2R, which is a conservative estimate. So given our earlier example with 10 trades a month with a 6R gain, at 70% efficiency, your monthly gain would be 0.
So the numbers add up at the end of the day if we reduce the risks.
So you need to be able to fix mistakes, which means, there's some tasks and trading that involve doing this, which we cover in our peak performance workshop. But it's like you need to analyze yourself to see what's going on. You need to mentally rehearse for anything that might come up that would cause you to make a mistake. And you need to do a daily debriefing at the end of the day to make sure that if you made a mistake, what happened to cause that mistake, and how can you make sure you don't repeat the mistake again? And that can be used to get you down from 70% efficiency to perhaps 90% efficiency.
And the super traders that you train, Van, what percentage do you encourage them to push
towards? They don't graduate until they get to 95% efficiency. So sometimes that's where I get these numbers, because sometimes they usually 70% is good when they first start tracking. And so they need to that's a lot of work to work on yourself to figure out how to get above that. So then the third impact is what I call market type, and there are 6 market types, which would be bull, bear, sideways, under quiet and volatile conditions. And what people don't realize is it's really easy to design a pretty good system for any one market type. Well, maybe, and it's really insane to expect that system to work in all market types. And what most people are doing is they're trying to figure out how to make their system work in any condition, and it's insane. And then lastly is kind of the impact of size and position sizing. So in a small account, you can really make a lot of money. We used to have professional day traders in the US who'd act as their own broker, and they'd specialize in one stock, and they'd almost be the market maker for that stock because they traded extensively throughout the day. And you'd have an account of maybe 25,000, and people could make 100% a month. And then they have to take the profits they made, put it someplace else, and start again with 25, because if you're trading more than 25, you'd be manipulating the market too much in that particular stock. If your account is much bigger, like $1 million, but even $1 million or less, then you can still, I just gave you the formula for making 72%. You could easily make 100% on that. Because with $1 million, there's still plenty of opportunities, and you're not necessarily controlling the market, especially with lots of equities to invest in. But then again, if your account's in the billions, then if you made 15% a year, you're probably one of the best in the world.
So for some of those first-time traders starting out with a small amount, but a reasonable amount, there still is some optimism out there in terms of how much they can actually make month on month.
Yeah, it's possible. You have some advantages, but not if you make mistakes and you don't know what you're doing and you have non-useful maps that don't function very well. So, I think some of the key lessons for trading success from all of this, well, first of all, you could take any really good system and probably increase your returns dramatically by just concentrating on not making mistakes. So there are a lot of people who bring perfectionism to the market. They want to be right. Well, being right isn't about predicting the market and actually being right on every trade. Let's make being right not making mistakes. I think it's a much, much better definition. And then understanding, so this is kind of like, we had a portfolio manager who took the Super Trader program, and he said, you've just taught me how to manufacture R. And I get that through working on myself. So the system generates a certain amount, but you don't because of your inefficiencies. And now, because to work on your inefficiencies, you can manufacture R. And then if you realize that there are different market types, and you can have a different system when the market type changes, it gets you into all sorts of different ideas that you can use to make money. It's kind of part of what I think of being a systems thinker, where you realize that the profit is an interaction of yourself, the system, and the market. And all of those three things together are, it's not one factor that causes it. It's all those things working together that you need to master.
Thank you, Van, for summarizing the key lessons of this discussion. We look forward to many more to come.
Thank you, Ron. That was really good.